Hello and welcome back, guys, to the channel. So this is it's your boy Howie once again, and in this video I'm mainly gonna be talking about liquidity, right? So what is liquidity and how liquidity works in this forex market, right? So without further ado, guys, don't forget to hit the like, subscribe if you haven't, turn that bell button on, and let's get into it, right? So on my charts here, I'm having Euro USD pair, right? And this is the 4 hour. So in the previous breakdown video, the weekly breakdown video, I did say I did speak about Euro USD, and we were at this point here where price was moving bearish. It's a little ICT concept called AMD, where the market just makes this fake makes this accumulation, right? This consolidation, and accumulates orders, bullish orders in the downside, right? And bearish orders in the upside. As you can see, we clearly have this trend line liquidity is being engineered, right? And I will talk about liquidity. Just hold on to it, right? So we have these trend lines liquidity that most of dumb traders and retails are looking to sell here and buy here. So what price does is price always takes liquidity, right? So the motion and overall movement of price is based on the general concept of liquidity. Price creates and takes liquidity over time. Now, what's important as a trader is to know what liquidity is and which liquidity is going to be taken next. That is how you get to be on the right side of the market. And judging by this, we were already here, right? We were here at that time when I was making this video. This was like 19th May, and after this happened, I did say that price was gonna go bullish. Why, right? Why was price gonna go bullish? Price was gonna go bullish because this is it's a little ICT concept called AMD, where market accumulates orders from the upside and the downside, liquidates the first side, and then liquidates the next side, right? So what price did is liquidate the buy orders and then came to liquidate the sell orders with this buy, right? And when we were here, I did say that price was gonna make a retracement. My POI by that time was this one here, but eventually price didn't reach here. But of course, I did not miss the entry. And let's not talk about this, right? Let's go back to liquidity, right? So I was just showing you guys how I did use these concepts to make that video and say what I did say about Euro USD. So I did say that price was bearish ever since this low was broken. We were all bearish in here. Now what okay, shit, that should go back. Okay, now what smart money does is create and engineer engineer and take liquidity over time, right? So what's liquidity, right? So let's come back now to our main concept. What's liquidity? Liquidity simply means money, right? In these forex markets, liquidity means money. Liquidity is that area where the money sits in the market. And what's the money, right? The money sits in the market in forms of buy stops, of sell stops. In a simple language, the stop losses, right? So if the market is moving bullish, while we're having highs and lows being put into place, right? In the realistic sense, we're gonna have some things like this, right? So price will do this. This is how price realistically moves, right? Price doesn't move in a channel of high highs and high lows. No, it does move in a series of higher highs and higher lows. But within those higher highs and higher lows, there is intermediary structure that lies as liquidity. Now, as I did say before, that liquidity is simply the stop losses, right? So if the market is moving bullish, where will we as traders position ourselves? We will take the buys from these lows, right? We'll buy here, maybe, okay, at the retracements, right? Okay, so let's say that price break structure. Let me just use this. So price break structure, and after this structural high is broken, we're waiting for the pullback. The pullback to what? A certain demand zone that's in here, right? This certain demand zones, right? So and price retrace. So when price retrace, then we're gonna buy here, right? We're gonna have our buy orders here. And when we take these buy orders, where will our stop loss be? Most of traders will position their stop losses below the previous low or just below that zone, right? So these are the main areas that the stop losses would lie. Now, as I said before, that price moves in a sort of way that engineers and takes liquidity over time. How? If a person bought here, people have buys in here, right? Where would the stop losses be? The stop losses will be right below this zone, which comes to be what? Liquidated, right? So the process of engineering liquidity done by the smart money is mainly for the purpose of liquidating that liquidity, taking that liquidity for price to gain its momentum and go further in creation of highs or lows based on the trend that is currently there. So with this little bit explanation, let's go into the charts and see what I was talking about, right? And okay, let's just pull this down. Let's not delete that, it may help us. So okay, let's make it this a little bit wide and there. So after the break of this low, we are now having a series of what? Let's use the highlighter. A high, a high, a low, high, a low, a high, a low, a high, right? But with between this high and this high, there's this intermediary structure that would have occurred to be a low and a high, right? In the lower time frames, this is a low and this is a high. Now this is what we call liquidity engineering by smart money, meaning that they engineered liquidity by creating a low and then a high, meaning that people bought here, people who bought here have their stop losses where below this low and below that low, right? So we have stop losses here and here. And people who bought here, who sold, people who bought here have their stop losses here and here. Or people who sold here have their stop losses where we have stop losses here, right? So these are people's stop losses and here. Boom. Now, as you can see, price comes and takes this liquidity. Now, after liquidity is taken, the next thing that you're going to see is the increase in momentum in that market, right? Increase in momentum. Now, once this liquidity is taken, look at what price does, right? So price fires to the top side with this huge candle, which if we could have been using volume, you can see, this is clearly visible. You do not need indicators to see that, to see how much volume lies in this candle, right? You can see that this candle here, boom, this candle here, okay, my mouse is shaky, boom, this candle here, this candle there is a lot of volume in there, meaning that price, the momentum is very high, right? And price comes to the top side and takes this liquidity here, right? And once this liquidity is taken, look at the momentum, guys. Look at the momentum. Look at this. Look at these bearish candles that follow, right? This to this, right? Look at those bearish candles. There's literally no bullish candle between there, right? From this high to that low. So this shows you how much momentum price catches after taking liquidity, right? So let's delete all this shit here and move on, right? I'm gonna make as many examples as I can for you to be able to understand, because as usual, guys, we don't want to keep these long. Okay, so price now creates low, and after creation of that low, we need to see creation of a high, right? Okay, so where's that high gonna go? That pullback. Lo and behold, boom. So this is that pullback. And look at what this pullback does, right? And as I said before, liquidity lies where stop losses are. And most of the time, like over 90% of the time, stop losses lie below the lows and above the highs. Okay, so let's put this as as a downtrend, and another one here as an uptrend. And let me just show you guys what I was just talking about. And boom, right? So we're having these two charts. Let's say we have these two charts. The first one is a bearish and the second one is a bullish, right? And in this bearish, if people sell here, they're gonna have their stop losses here. I mean, above this high, these highs, right? Stop losses are gonna be there. If people sell here, they're gonna be having stop losses here and here, right? So you can see that in a downtrend, stop losses normally lie above the highs, while in an uptrend, if people buy here, they're gonna have the stop losses below that buy and below this low, right? So in an uptrend, stop losses lie below the lows, right? So let's term them in a swing low and a swing high manner, right? Liquidity lies above swing highs and below swing lows, which is above swing highs. So these are the swing highs, right? Above swing highs and below the swing lows. And if you don't not know what a swing high and a swing low is, okay, let me put a little bit clarification in that. So okay, I do not understand why this keep okay. Cool. So let's delete the shit and the shite here. So what's a swing high and what's a swing low? If you have your candles like this, you have your candle there, and you have your candle there, and you have your candle here. Boom. So these three candles, right? You can see these three candles, and they have what? Wicks. They do have these wicks, right? So a swing low is that wick that's above. It's like a head and shoulder wick, right? A wick which is above the left wick and the right wick, right? So this right here is what is a swing high. And if you turn this around, that's a swing low, right? Meaning that in a swing low, it needs to be lower than the left wick and the right wick. So that's the definition of a swing high or a swing low in just a very simple sense, because I did not anticipate talking about that. So let's dive into it, right? And as you can see, this is a swing high, right? This wick is above the right wick and above the left wick, right? This is generally a swing high. Now, as I said before, that liquidity lies above swing highs, right? So meaning that on top of this, there's liquidity. And lo and behold, look at what this move, shit, I mean, my mouse is just very boring. Look at what this move comes to do. So this move right here comes to take this liquidity here. And this is the concept that I myself call it absorption, right? So absorption is simply the move that liquidates the liquidity. If people sold here, all in here, people sold, right? And they have their stop losses just about that wick there. So price comes back up. This is a smart money move that comes to absorb all these stop losses, taking all these dumb traders out of the market, and then doing what? Catching that momentum to go to take price even lower. And there is where people sit back and say, what's happening? It's a downtrend. Now, why is price breaking up? This is not a breaker structure. It's simply a wick emerging above it, which I call it absorption. And you do not, if you don't know what absorption means, kindly roll back to the previous video of absorption and displacement, and you will know what I'm talking about right here. So after this absorption is done, all dumb traders are out of the market, right? And smart money are now enjoying the ride of taking price even further, right? Look at this momentum that price catches from this high to this low. I mean, that's a lot, right? This is like a what? This is like a 400, almost 500 pip ride. I mean, that's 500 pips right there. So you can clearly see, guys, how liquidity works, right? Liquidity is simply there to give the market its momentum to go further. But I will repeat this over and over again. Price creates and takes liquidity over time. Now, the only thing that you as a trader should know is where liquidity is and which liquidity is going to be taken next. So without further ado, guys, we'll finish this up in the next video. And if you like the content, guys, kindly hit us up on Telegram. The link is in the description, or you can DM us on Instagram at officialgreenpitx, or you can DM myself at Howitt. And without further ado, guys, until the next one, guys, peace.